questions. And between Scott and myself, we'll do our best to get your questions answered. Also, feel free to follow us on Twitter at Brent Moores CS, at Scott Thompson CS, for additional content that we post throughout the week. Now, before I get too far into this, let me just remind everybody that the material today is intended for general, informational, and educational purposes only. This is not an individual recommendation or personalized investment advice. Even though we will look at individual stock symbols today, those are not actual recommendations there. And there are risks associated with investing in dividend-paying stocks, including but not limited to the risk that stocks may reduce or stop paying dividends. And Schwab does not recommend the use of technical analysis as a sole means of investment research. Paper money software application is provided for educational purposes only. All investing involves risk, including loss of principal. Past performance is no guarantee of future results. And diversification does not ensure a profit and does not protect against losses in declining markets. When the market is going down, most stocks tend to go down with it, including dividend-paying stocks. If you do use stop orders, just remember there's no guarantee that execution of a stop order will be at or near the stop price. So, hey, let's head on over. So let me tell you just something that I'm going to do a little different today. Typically, Cameron is using the Thinkorswim desktop software for this webcast. I'm going to be using the Schwab.com website for the majority of this webcast. And a lot of you are familiar with this website. And there's you can use either to search, to scan, to find potential dividend stock candidates. And that's what we're talking about today. But I want to give you a glimpse of that. By the way, to go where I'm at on this page right here, you go to research, you can click on stocks, and this is the page you're going to see. Now, I mentioned that we're going to talk about dividend growth investing. What is dividend growth investing? First of all, any of this dividend investing that I'm talking about, or primarily what Cam is talking about each week, is a longer term focus. I know in a lot of our webcasts, hey, we talk a lot about shorter term trading. Here, we're talking about a longer term investment here. So maybe we're going to de-emphasize some of that technical analysis and look a little bit more at the fundamentals of the stock. That's the first thing. We're going to be looking for higher quality stocks. We're not chasing super high dividends. We're looking for higher quality stocks that have increasing dividends year over year. That's one of the key elements of dividend growth investing, increasing those dividends over time. And so ultimately, we're going to be focusing on getting more money as from the investor standpoint. We're focusing on more money from increasing dividends each year, plus hopefully capital appreciation. How does that work? Obviously, if they're increasing dividends year after year, you're getting higher dividends. Also, it can be a good sign for a company. If a company is increasing its dividends each year, most investors will perceive that to be a positive sign for the company. Because generally speaking, and there are exceptions to this of companies that have increased their dividends and all of a sudden the company's going out of business or something like that. That's atypical though. In general, from I think the perspective of most investors, increasing dividends is a sign of confidence by that company that they're able to pay out more. Now, we're going to put some guardrails on this. We want to make sure, we're not just going to trust just because they have increasing dividends that the company is going to do well. But so that's how we're going to focus there. Okay, now let's talk about starting with dividend investing before we get to the specifics on this. If you are newer to this webcast or newer to the Schwab.com website and not familiar with it, I want to point out to something. There is a Learn section on this website. If you click on Learn and then go to Courses, see that? Learn, Courses. Click on Courses, and it comes up with courses here. I have found personally, sometimes when I click on courses, it doesn't immediately come up to courses. It comes up to something else. You can just go to the submenu here and click on courses if it does that, and then it will bring you to this page. We have a bunch of different courses. Some of them focus on different things. Simple steps to a retirement portfolio. This is outside of the scope of a lot of what we teach in our Trader Talks webcast, which, by the way, I encourage everybody to subscribe to so that you don't miss any of our so you can see our webcasts and you're notified of our webcasts, and you're not getting the millions of other videos that occur on YouTube pushed to the front of your feed. This is a great course, by the way. I recommend you going through this Simple Steps for a Retirement Portfolio, even if you're not retired, or even if you're not right about to be retired. There's some good concepts in that. Stock investment with fundamental analysis, stock trade, and there's one down here that says income investing. That's the one I want to just point out to you right now. If I click on income investing, it's going to talk about income investing, kind of general stuff. And then it talks about dividend investing. And notice there's different kind of chapters, if you will, in this. Dividend Stocks Foundation, dividend stock analysis, and then it goes into bonds. I'm not going to get into bonds today, but a lot of you may be interested in bonds. What are bonds? How do they work? How do you invest in them? All good questions, all discussed in this course that I'm talking about. Bond Foundation, bond analysis, and it talks about REITs. I'm not going to get into REITs today, but again, there's more information here. There's this dividend stock information here, which I encourage you to read through. And the nice thing is, it's outlined in such a way that you can kind of, I don't know if skim's the right word, you can selectively go through the sections that are of interest to you. Maybe you're not interested in bonds and you just want to do dividend stocks. You can go through here. One of the items that I would point out on here, it's a little bit hidden. If you scroll down to the bottom, it says resources. Under resources, it says income investing sample plans. I want to look at this for a sec because this is a sample plan. It's a starting point. It's not a recommendation you use these exact parameters, but I think it's a good start in terms of giving you some ideas. And I want to just go through some of these, and then we're going to tweak these a little bit for our purposes today. But I thought we'd start with kind of the basic blueprint, if you will, and then we'll talk about some modifications. But let's talk about some of these items on this list here. Number one, obviously, if you're investing in dividend stocks or dividend growth investing, you want a dividend yield. Now, on this plan, it says the current dividend yield greater than a benchmark like the S&P 500. Well, I'll tell you what, the current dividend yield on the S&P 500, last I checked, which was a couple months ago, is something like 1.2%, which is pretty low historically, pretty low. So in my mind, greater than the dividend yield, greater than the benchmark like the S&P 500 isn't asking much. If a stock is paying a 1.2% dividend, I'm not really considering it much of a dividend stock here. Okay, so we may up that just a little bit here as we go and look at this. Let's go and let's look at the next one. The stock that's been raising its dividend over the past 5 years. That's great. That's the core of dividend growth investing. Okay, that's the core of dividend growth investing. Now, Eva in the chat said her goal is, her benchmark isn't this S&P 500 average dividend, it's the inflation rate. Does that make sense? I think that makes sense. That's not a terrible thing to look at. Inflation obviously changes. For many years, inflation wasn't very high. The last few years, inflation has been fairly high. So I think that's not a bad idea. Not a bad idea. Not a recommendation necessarily, but that is not a bad idea to consider that. Okay, 5-year dividend payout ratio. What is a dividend payout ratio? A payout ratio is just saying how much we are paying out in terms of the amount of earnings a company is bringing in terms of the dividend. Okay, so let's think about this for a sec. If you bring in money, just think about your own personal situation, not a company right now. We'll make the analogy. You're bringing money, you bring in a paycheck perhaps, and you spend money. Well, this money you spend hopefully is less than the money you bring in, especially because there's a lot of different things you can spend money on. And if you compare that to a company, if a company brings in money, its earnings, it can spend some of it on a dividend, but you don't want it to spend all the earnings on a dividend because there's other things you got to spend money on too. And so if we get a payout ratio where we're spending almost everything we're earning on a dividend, that's probably not sustainable necessarily. Maybe in the short term we can do that. Just like in the short term, you can probably spend more money than you bring in a given month by dipping into savings or something like that. But we're going to look for something like, in this, it says 40% is kind of the blueprint here on this, 40%. Some people will go higher. That's not a problem. 40% is relatively low. Certainly, I think when people start to see dividend payout ratios up in the 80% range or something like that, that's kind of a red flag for a lot of traders there. And I'll show you how to add that how to look for that, okay? Return on equity. Now, this has nothing to do with dividends, but this is just saying how efficient is the company in terms of its operations. Regardless of whether a company pays a dividend or not, we want a sound company. Okay, a sound company. Why? Well, a sound company's more likely to be able to appreciate in its stock price. Remember, that's one component of what we're looking for. And number two, it's more likely to be able to sustain paying a dividend and perhaps even increase that dividend there. Okay, now let me go through. There's a couple more here I want to look at, but let me just point out something. There's a survey link in the chat, and we always appreciate your feedback, and we read your feedback, by the way. So you don't have to fill it out right now. You can fill it out at the end of the webcast, but the problem is once the webcast is over and we shut it down, the link, you're not going to see the link anymore. So you may bring it up now and look to fill it out later. Let's continue though. Debt to equity ratio. This is kind of getting at the same thing of we want a financially sound company, a company that's not burdened by too much debt. And a PE ratio. We want a company that's trading at a reasonable variation. Now, the suggestions for these two are debt to equity of no more than 1 or 100%, how you express that, which isn't that difficult of a hurdle to meet, and a PE ratio between 10 and 30. Okay, so this is the investing plan, the sample investing plan that we can use on this. I'm going to remind you how to get here if you're interested, but let me also just point out something that I'm not going to get into today because I'm not going to talk about mutual funds or ETFs today. But if you are interested in looking at ETFs, for example, a dividend paying ETFs, and there's a bunch of them out there, there's some sample rules you can use here on this as a starting point for you. So I'm not going to get into that right now, but just as a reminder for you, if you are interested in going here, you simply go to Learn, you go to Courses, and then you can scroll down, and here's the courses, including the I missed it. There's an income investing course right there, income investing course. Now, let me hit up questions. Then I want to talk about some modifications to use the Schwab.com website to find some of these dividend paying stocks that meet our parameters. Question from I saw Harry. Oh, on options, and it looks like Scott answered that question. That's great. But hey, point is, we have a variety of different courses, options for beginners, options for more advanced users as well. And while I'm on the subject of options for advanced users, hey, I teach a webcast on Fridays called Condors, Calendars, and Butterflies at 2 o'clock Eastern time. I invite you to if you are interested in advanced options. But just remember, there's a lot of different courses here. Okay, let's go back. Let's go back to the website. I'm going to click on research. I'm going to click on stocks because we're trying to find stocks. We're trying to search for stocks. And so I'm going to click on Stock Screener. Click on Stock Screener, and this is the page that comes up. Now, Schwab has created some prefabbed stock screens or stock searches for you if you're interested, by the way. And one thing to kind of keep an eye on the Schwab.com website, if you're not super familiar with it, there's quite a bit of functionality that they kind of tuck in there, but you got to click on View More. So if you click on View More, you're going to see more of these. Dividend, high yield, and momentum, dividend growth, dividend sustainability. So you can check those out. But today, we're going to create our own screen, and we're going to kind of use what we said before as a baseline, but we're going to modify it just a little bit. So, number one, what I'm going to do is I'm going to click on Basic. And the way these screeners work is you click on the general category on the left, in this case, Basic, and you see a lot of subcategories. And in this case, I'm going to go to market cap. Now, you can, if you want to start with just say S&P 500 stocks, which is something that I often teach in webcasts, then you can go to index and select S&P 500. But when you put the check mark here, it gives you the choices, and you select the choices that you want. I'm going to do mid cap and large cap. I'm going to stay away from small cap, micro cap. In general, most dividend paying stocks tend to be the bigger companies anyway. Theoretically, you could have a high paying micro cap or something like that, but not what most people's idea of what they're looking for here. Now, that actually doesn't match what was on that investing plan, but I think it's an important one to consider looking at. By doing this, we're now at 1,100 stocks. Okay, too many to look at, and we're going to screen it further, but it narrows it down, narrows that list down. Now, there's some other things that we're going to look at that are mentioned. I'm going to hold off on the dividend stuff for a sec here, but I'm going to pull up return on equity. Let me close out that Basic. I'm going to go to company performance. That is not what I want. I take that back. I got to remember financial strength. And I'm going to click on return on equity. And the sample investing plan suggested 10% or more. I'm going to stick with that. Now, I can click 10% and 20%, but I don't want to exclude something that has a 25% return on equity. So I can just click these other ones that I want to select there. So there we go. Okay. Similarly, I want to do debt to equity. And again, I'm going to go with what the investing plan has. You can tweak this. Now, something you need to understand about debt to equity, sometimes it's expressed in different ways. Sometimes you may say, well, debt to equity is 70%. And when you're talking about that, where the debt is 70% of the equity, for this, you're going like 70%, that seems kind of doesn't really fit with what these numbers are showing. that would be equivalent to like a 0.7 here on this. So don't get confused by that. Now, this 1 would be equal to 100%. Now, let's say you don't want that. Well, I don't see a 0.7, I want 0.7 or something like that. How do you do that? Well, you can do that by clicking on enter specific values. And I could say, well, I want it less than or equal to, and then I could put in 0.7 here. And there I've put in my specific value there. But in this case, I'm just going to go with what the sample plan has, and I'm just going to put on less than 1% there. Okay, less than 1. All right, let's keep going. I'm going to do a PE ratio. Now, PE ratio is going to be under valuation, and I'm going to use the same parameters that we used in the on the sample plan, and that's 10 to 30. So to encompass 10 to 30, I'm going to do 10 to 20 plus the 20 to 30, and we have that. We're down to 300 stocks. Now, we haven't done anything in terms of dividends yet, but that's what we're going to turn right now. Let's go to the dividend category because there's quite a few of these. So we emphasized payout ratio. Remember, payout ratio is how much the company is paying out in dividends in terms of the amount of money they bring in. And I'm going to click on payout ratio, 5-year average, because that's what the plan says. And I'm going to say less than 40%. So I can go 30 to 40, 20 to 30, or under 20 is fine too. But we're going to up it a little bit here. We're not just going to say a payout ratio over the last 5-year average. We're going to say the last trailing 12 months of payout ratio. I'm going to do the same thing. So not only are we looking at the long-term focus, we're looking at the shorter-term focus. Now, you may say, of course you want it to be good now and good over the last 5 years. What's the case for not doing that? The case for not doing that is sometimes the payout ratio can fluctuate up and down. It has some intra-year volatility for whatever reason. And so that's why some people will just stick with like the 5-year and not just look at the current, but we're going to look at both for our case here today. Let's move forward. I want a company that is increasing its dividends, not just year over year, but we are going to do that. So I'm going to click year over year increasing the dividend. Now, this doesn't give me a spot to put in right here the numbers. I can click on enter specific values, but right now, let me just do this because I'm going to show you. I'm going to show you this. I'm going to press increasing or decreasing dividends. I'm just going to click on increasing here. And I'm going to go and I'm going to also add in a 3-year, a 5-year, a 10-year. We're adding a lot. Remember, our focus is dividend growth investing. So over this time period, I want it to be growing at least 5% over the last 3 years, at least 5% over the last 5 years, at least 5%. This is annualized by the way. So it's not 5% over the sum of the 10 years. It's 5 years on average for each year over the last 10 years. And now we're really narrowing this down. One other thing, if I just run this as it is right now, then I'm likely to get some stocks with some dividends that are, 1%. It can't be 0, I guess, if we have a dividend growth rate there. And or maybe, we get something with 10%. And Cam actually did a great webcast, I think it was last week in this class, that was talking about some of the dangers of those higher dividend stocks. So we're not searching for uber high dividend stocks. or super low dividend stocks. We're dividend growth investors, so we're going to look for something kind of in between. Now, I need to put in dividend yield, and it's right here, annual dividend yield. And so what I'm going to do is I'm just going to go maybe 2 to 4%. Okay. And there we got some company. We got 9 matches. That's a manageable list, by the way. Okay. That's a manageable list. So we're going to look at these stocks. That's the next step in the process. But let me go before we'll hit up some questions here. There was a question regarding REITs, and I'm not really going to get into REITs today. However, I saw the question, and now I don't see it, but I know it was there, and it was, does the increasing dividends rule out REITs? If I'm remembering what the question was correctly. The answer is REITs. Okay, so this is just going to be a brief discussion on REITs. REITs, by law, have to pay out 90% of their earnings in terms of the dividend. So it's not so much a discretionary increase in the dividend. It's more just pegged to earnings. And of course, companies typically have earnings that go up or down on a particular year. And so that REIT dividend may fluctuate a little bit more. I suspect you'd probably find fewer REITs using it this way. Nothing against REITs, and Cam has some webcasts on REITs that you can look at too. Again, in the same playlist that you can look at there. Okay, let's view those 9 matches, by the way. So I'm going to click on View 9 Matches. And by the way, let me just mention this. When we are looking at when you do a search or a scan or a screener, those are all synonymous terms I'm using. And you create it, and maybe you run it and you go, well, I don't like it. I want to tweak it a little bit, and you tweak it a little bit, and you refine it, and you come up with something you like. What you're going to want to do is you're going to want to save the screen. Okay. That way, in the future, you don't have to build this screen from scratch, right? You don't want to have to do that. So save the screen, and then in the future, when you go back to it, you can do that. But let's look at some results. Some of these names are going to be companies that you likely know. Most of you probably have heard of Aflac, big insurance company. Barrick Mining's a big mining company, Bank of America. And then there's some that are not so big. And these are the mid-cap stocks, okay? And I'll tell you what, let's look at maybe some that aren't as popular. There's nothing wrong with these, except in a lot of my other webcasts, I look at companies like Aflac or Barrick Mining or Bank America. So maybe we'll kind of initially look at some of these. And if you don't like some of these, then you can go through the whole list there on that. Okay? Just a reminder, we do have a survey link in that chat here. Appreciate your feedback. But let's go. I'm just going to go to the bottom of the list because we got mid-cap. Actually, before we do that, let me point out some things. You got your columns here with the parameters. If you don't see all the parameters, there's a little scroll bar. We may need to scroll over there. Another thing I would point out is, I didn't do it this time, but something I sometimes do is I'll put in a screen for a sector, and it asks you which sector you want to look at, what you want to narrow down to. And what I do is I don't even put any sectors in there, but what it does is it adds a sector column, and then you can see which sectors they're from. Well, this is going to be financials, this is going to be materials and financials, and so on. And, there's some different ones there. That's a financials, and that's a health company. But anyway, that's how you do that. But look at the columns. Market cap, large and mid cap. We know that. Return on equity, we're teens for the most part, okay? Not massively high, but also not really low. Debt to equity, You can see it expressed there. PE ratios, payout ratios, and so on. Okay, and then if you want to see more, you can scroll over. As I mentioned that. Here's our dividend yields. Let's just focus on dividend yields for 1 sec, then we're going to look at some individual companies here. Annual dividend yield. Remember, I said that S&P 500 average dividend, this is probably slightly dated, it was a couple months ago I looked at this, was averaging about a 2.2% yield. Well, the S&P 500 has fallen a little bit lately, so actually that yield may have gone up a smidge at least. But you can see we're well above that on all these because we know they're going to be at least 2%. Nothing super high here. We got a 3.5%, about 4% on I think that's Bank of America right there. But all kind of in that I don't know, the sweet spot that we're looking for. Because remember, we're not just looking for a high dividend, we're looking for a company that's going to grow, and hopefully the stock price grows. And if the stock price is growing and the dividend is growing, that's a beautiful thing. All right, there. Okay. So, question from Melissa. How's the dividend yield percentage calculated? It's the amount paid out in dividend per the stock price. So if we just talk on a per share basis, let's say we had a stock that's $50 a share, and it is paying a $1 per share dividend. That yield would be a 2% yield. Okay, you can do the math on that if you want, right? 1 is 2% of 50. That's how that is. If a company is paying out a $1 per share dividend and it's a $500 company, that's not much. That's 0.2% dividend, which is very small. But there's some companies out there that do that. But that's why dividend yield is, I find, a good way to look at the amount of dividend paid, because if you just look at the actual dollar amount being paid, it's very different looking at a $50 stock and a $500 stock. They're telling you very different things, because you can own 10 times as many shares of that $50 stock as you can the $500 stock. So you'd get 10 times the dividend in that regard. Okay, so hopefully that helps there. Okay, let's take a look. And then some of these companies you may not be familiar with, but what you do is you click on the symbol. Click on the symbol. Here's State Street, which is a large financial. Well, it's mid cap. It's not large cap, but it's still pretty sizable, and it's something that some of you are probably familiar with because of if you're more, maybe you follow the financial industry a little bit more, you'll probably see State Street. But you click on that and then you click on the name. Okay. And so then it's going to come up. And if you can look at, obviously there's a bunch of different information you can see on the company over here, including things like, what's my short interest on this company? 1.5%. Well, that's not ridiculously high, so that's probably good. High is generally not a good thing on short interest, but if you start seeing something up closer to double digits or something like that, that'd be most investors would perceive that to be a very bad sign. You can see your analyst reports, which are third-party reports. They're not recommendations. They're not endorsed by Schwab, but they're a good, they're something that is popular to look at. But if you scroll down a little ways, you see the dividend category. Now remember, I told you earlier, you got to look for the show more. You click on show more, and what we can do is we can see the dividend year over year, and we can look at it. The number's a little hard to see, maybe a little small on your screen, I don't know. And you can see that dividend each year. You can also see the percentage increase. of it. That's what we're going for. We don't want it. Now, so it did have a decrease 1 year. How's that possible when we put in all those parameters? Well, remember the parameters we put in. We put in last year's, it has to be increasing last year. And yeah, last year it was 46% increase. We also said the 3-year average and the 5-year average and the 10-year average have to be increasing. That didn't exclude it from having 1 year of a drop in the dividend. But there you go. That's one of the differences between doing this approach and doing something like a dividend aristocrat approach. For those of you who aren't familiar with dividend aristocrats, those are companies that have increased their dividend each and every year for the last 25 years. But it doesn't really put a minimum on the number. They could have increased the dividend by 1% each of those years. So pros and cons to both of those, I guess. But there you can see the dividends there on this. And so that's the way to look at that. So let me go, and you can scroll down. And by the way, you can see it's compared to some of its peers out there. And the yield, like this has a pretty high yield. Doesn't mean it's a good company necessarily. It may be, I'm not sure. It's not one I've looked at, but that has a higher yield. But you can see where State Street compares to some of its peers there. And you can see payout ratio is about 33%. So let me go, let's go back over here. Actually, let me go back here. And I'm going to shrink down the dividend category because there's other things you may want to look at here. We mentioned the analyst reports, third-party reports. We looked at the dividends there, but you can also look at historical earnings. Because remember, when we're looking at a company, how's it going to continue to pay out increasing dividends over the year? Well, by its fuel. Its fuel is going to be the earnings that it brings in. Now, Trevor, you ask a great question in the chat. Can we do similar stuff on the Thinkorswim platform? The answer is yes. It's not going to be exactly the same. Some of the parameters are a little bit different, but you can get the gist of it on the Thinkorswim platform, and I'll show you that in just a minute. Okay, but I'm not going to be able to go into the same depth on that Thinkorswim platform, but just to show you. Now, look, let's go back. Here's our companies, and you can look at some others. Here's a large cap, but it's not like a household name, I don't think, like Bank of America or Aflac. Elevance Health, okay? And so we can pull that up, and remember, once you bring it up there to see the full report, you can go to Elevance Health. Click on the name, and it brings it up. And again, you can see things like, and if you want to know more about it, you can read the business summary. Click read more, gives you a whole, I'm not going to take the time to read it right now, okay? But there's your company profile. There's your analyst info. There's your dividend info for the past. This is just the past year, but we want year-over-year increases. So what have we seen? Well, you can see the increases, 7%, 19%, 19%, 13%, so on, going up. So, and this is just this quarter. This is just one quarter's worth. So don't worry about the significant drop there in that dividend. So what I'm going to encourage you to do is run the screen. Run the screen. You can tweak the screen if you want. Come up with your results, and then look at some of those results. And if you like the results you get, perhaps save the screen. And when you save the screen, then you can run that screen in the future, and then different stocks may come up in the future. I mean, if I run it tomorrow, it'll probably be pretty much the same stocks. But if I run it 3 months from now, we may get a few different ones on there. Okay, now, I want to wrap up here in just one sec, because we're almost out of time. But let me just mention this. If you want that fundamental information on the Thinkorswim desktop software, you can go there. To actually run the scan, you go to the scan, you can go to Stock Hacker, and you can start adding filters on there. Let me just reset this for a sec. Okay? And let me remove my filters. Here's your filter. This is kind of analogous to the screener that we have on Schwab. You click on Add Filter, and then you can click on different things. I'm going to click on Fundamental. And when you click here, you can look and you can say, oh, dividend payout. Oh, we already talked about dividend payouts. Yeah, dividend yields. We talked about dividend yields, and so on. They're not all going to be the exact same, but you can get a similar type thing here. Finally, if you want to look at the specific information, go to the Analyze tab, go to Fundamentals. SPX probably isn't going to work. Let's do Coke. Okay, here's Coke. And pull on down, and you can see the information. And here's the financial information. You can see growth rates in earnings, dividends, etc. All right? Okay, everybody. Now, let me just remind you as I wrap up. If you are interested, I post additional financial market information pretty much every weekday on X, at Brent Moores CS. First thing. Second thing, as I mentioned before, there's a survey link. We appreciate your feedback. Now, if you did like what we did here, you're doing me a favor if you click on the like button, the little thumbs up there at the bottom of the page. We do appreciate that. And it also helps to spread the word of Schwab's free education out there. And it's helped support us. So we do appreciate you. I appreciate each of you for joining me today. I appreciate Scott for helping me out in the chat. We got the survey. Coming up next, we have Trading the Trend. Okay? Make sure you check that out. Everybody have a wonderful rest of the day, and a nice weekend ahead, and a nice holiday weekend. Remember, tomorrow is a Good Friday holiday. The equity markets are not open on Good Friday. So, bye-bye, everybody.